Hi, I'm James Robinson, and this is my stock pick of the week. This is part 2 on my analysis of Gilead. Today we're going to look at the operations of the company. So the first thing that you see here with Gilead, and the thing that has me willing to overlook some of its flaws and vices, are these gross margins. They're exceptionally good, significantly above the top 10%. This is something that gets me really excited about the company, and it's a very strong reason why I'm suggesting you should consider buying it. Another reason why you should consider buying it is the earnings. If you look at the earnings, they've had one losing year since 1999. They've grown pretty significantly since 2002. They managed to raise their income during the recession, the Great Recession. They had a couple of peak years a couple of years ago. I think those were aberrations. If you take those out, those 3 years out of the equation, you see the company kind of is continuing to go along kind of a straight line trajectory. And so I'm comfortable saying that this company's earnings, as well as earnings per share, are good. The earnings per share are have increased significantly faster than the earnings. And of course, that's because the company's been buying back shares all along. So the same amount of earnings are being spread over a smaller number of shares. Net earnings as a percentage of revenue. You can see here, this is a bit of a mixed bag. Generally speaking, this company's been in the top 10% for most of the last 25 years. However, in the last couple of years, it dropped down to below just barely above my goal or barely below my goal. I think that's a short-term blip. I think the company's going to continue to do well. I think it's strong enough in other categories that we can overlook some of this bumpiness in terms of this chart. Selling and general administrative for this company is, generally speaking, very good. It's in the top 10% for many of the last few years, and close to the top 10%. Really since, call it 2005. So the company does a very good job of controlling their sales and general administrative costs. Plant and equipment, same thing. They do a solid job. They're not quite in the top 10%. But they're close enough to it that I consider this company to be very well run in terms of both plants and equipment and in terms of selling and general administrative. Inventory and revenues, this company didn't seem to do a good job of that till about 2013, 2012, I guess. It sort of had a peak, and they were doing very poorly. They're in the bottom 10% in terms of inventories as a percentage of revenue. However, every year since then, they've managed to bring it down. It's now still a little higher than I would like, but really not so high that I have a real problem with it. A company like this is going to have to carry some inventories. When you're making drugs, you just need drugs in your inventory. R&D to gross profit, this company has a problem with that. They're in the bottom, really 25%, and sometimes the bottom 10%. That's the price you pay for patents, and I'm willing to overlook it because they do a good job of R&D. I'm sorry, they do a good job of plants and equipment and SG&A, and they're doing a better and better job in terms of inventories. And typically, every one of our companies has some area where they're a little weak in those 4 taxes. I just don't like to see 3 or 4 areas where they're weak, and so again, we'll overlook that. Generally speaking, this company's very, very well run, and they do seem to do a good job with getting value for their research and development dollars. So in summary, the gross margins are excellent. In fact, they're as high as I can remember seeing. I don't remember a company with better gross margins than them. It's that's the primary reason I was willing to overlook some of the company's other issues, such as them being dependent on research and development and them having more debt than I would like. The company's done a solid job of growing revenues. They've grown from $1 in profit in 2008 to $4.17 in 2018. So that's obviously a good sign. The R&D is very high. However, again, that's the price we pay for monopoly created by patents. Selling, general administrative, plants and equipment are all, they're above the best companies. They're high relative to the best companies, but they're generally speaking very well run, and they're in the top 50 to 25% of companies in the S&P 500.